Hey everyone, today I want to talk about how I made a little bit over 20% this month on options. I am a premium seller, so I sell options and I sell put and call spreads to maximize my return based on the amount of capital I have. And over the past month, I was down a little bit going into the beginning of the month where everybody was down right around that March 23rd, 25th area. And then since then, I've really managed to recover. And then I'm up 21.6% right now as I speak. I know the markets are open, so that might vary just a little bit, but so far it's been a great week, and I want to talk about the strategies that I use to do that. As always, I'll have a little bit of jelly right at the end, which is something I enjoyed outside of the markets. Welcome to the Portfolio Bulletin. Let's get started. The first thing I do is I go over to the Tastyworks brokerage. This is a platform that does have some fees and some commissions. So if you are trading a small account like this, then you will pay some fees and commissions. However, they do execute extremely quickly, and I've had no issues with them. Robinhood has had some issues, which is a little off-putting, but I still use them for some short-term options because I do trade frequently. And since I trade frequently, I would like to reduce those commissions as much as possible. So I do use both platforms because Tastyworks has great tools. However, Robinhood has no commission. So if you use both platforms together, then you can get the best of both worlds. So once I get to this platform, I take a look at this little highlighted area, which is the expected move. This is based on some math, but it's calculated for you by the platform. You can see this is the price where it is right now. So in the money puts would be on this side, and then in the money calls would be on this side. So just a brief overview. Puts give you the option to sell a stock at a certain price, and calls give you the option to buy a stock at a certain price. So if the price goes down and you own a put, that put gains value, and if you buy a call and the price goes up, that call gains value. However, I'm a premium seller, so I sell call and put spreads. And the spread allows me to reduce the amount of capital I need to hold that position. But if you go out of the money pretty significantly, so on the put side, I try to stay in this 85 to 90% out of the money probability. And that allows me to get down to the 99% out of the money probability for my spread. So that allows me to maximize the amount of profit I'm getting from the put that I'm selling to the put that I'm buying to help for insurance. So if I were to go ahead and select this 273 put, I could go up here to the 266 put, and then I would click that so that it says buy to open on the lower put and sell to open on the higher put. And that's going to give me about a credit of 49 cents. So before I would execute this, I would actually raise that price up just a little bit, probably 55 to 60 if I'm feeling good and the price is trending down, which it's not right now. But I would put that order in, and that would give me just a little bit of leeway. So if the price comes down a little bit, then this order would execute and I would receive $60 for that put spread. However, that put spread is going to have an 88% probability of profit. That's what this is right here. Probability of profit. It all calculates that for you. So it says your max profit is the 60 cents, which will be $60 on 100 shares. My max loss, $640. But the probability of profit on that is 88%. So 12% chance of losing money. And that doesn't mean I'm going to lose all of this money, maybe some of it, but I will receive $60 if the price of the SPY, this is the SPY, is above $73. So in 3 days, if the price is above $73, I will keep all $60 from this option contract. So going to my actual positions here, right now I do have 2 contracts pending. And if they reach my limit price, then they will be executed. So right now, the price is trending up. So I'm pretty close to getting this call option spread put in for 60 cents. And that will expire on the 27th, which is 3 days from now. And you can see I have 4 contracts right here that will expire today. And in those contracts, I had 176 right here is what I received for this put. And then I paid $70 for the protection. So that's going to be a profit of $106 if the price closes above $275 today, which it looks like it will. And then as long as the price stays below $287.5, I will receive this $91 and I will lose this $16, which will result in a profit of $75. So I put these orders in a few days ago. So receiving $180 in a few days is an exceptional return. So the risk I had here was $800 total. So I could lose $800, but you can only lose on one side of this. So I could either lose $800 to the downside, but I would still make this $75 to the upside, or I could lose this $750 to the upside and I would gain the $106 to the downside. So I wouldn't lose all $750 that I have at risk. There's a chance that I could lose money, but the probability of not losing money is exceptionally high. You saw there that my call spread did get executed. So that was this call spread right here, 285 to 290. So I'm risking $500, which is the 5-point spread here, to make $60. So the probability of profit on that is currently 72% because the price is trending upwards and it will cross over the weekend. So on Monday, as long as the price does not go past 285 on Monday and it closes below that, then I will receive all $60 of profit on this trade. So as the price trended up today, I had that order in to ensure that I got a good price, where if I had put that order in at market price earlier, I would be down on that right now. So you do have to make sure that you get a good entry on these short-term options. Don't put in a call and a put spread at the same time. You definitely want to put them in with limit orders and make sure that you get a good price in the direction that the market is moving. Just to give another idea of what this looks like, here's a visual depiction. You can see at the top the profit at expiration based on the price and how the price is changing. So if it stays right where it is right now at 280, then I will receive $616 in profit. However, my break-even point is over here at about $288. So if the price rallies $8, I won't lose any money, but I also won't make any money. And if the market goes crazy and continues to rally up, I have potential to lose $1,634. So there is risk. Definitely don't think that this is free money. You are putting capital at risk and you need to be aware of the risks. So it has been a particularly volatile market because of all the coronavirus stuff that's been going on. And because of that, option prices are a little bit higher to account for some of the volatility, but there is certainly risk. And you see there's a little notch here because I do have a call position to the upside right now, and I'm legging into that, so I don't have a put position on the other side to balance that out. And that's because the market is rallying right now, and when the market went up, it hit my call, as you saw in the previous frame. All right, so what were the key takeaways of the strategy that I described today? The biggest thing I think has been legging in. So legging in means only putting the call or the put side in at one time. So if the market is rallying, then I'm going to put this short call in to make sure that I maximize the credit for that option. And then as the market dips, I'll put in the short put position to make sure I maximize the credit on that side, which allows me to have a wider iron condor, which is what's described here, than if you were to put both of them in at the same time. And this gives you a higher probability of profit by legging in. Also, I've been utilizing short-term options, and the reason that I use short-term options is so that I can maximize the credit received. So on short-term options, the credit drop-off in short-term options is significantly faster. So here's a graph showing exactly what I mean. This is a graph of a normally distributed option price. So the dashed line is the current price, and then the blue line is the price of the options. So the closer you get to the price of the underlying asset, the higher the price of the options, and the further away you get from that price, the cheaper the options. So this curve gets exaggerated the closer to expiration you get. So the price will be even steeper as you get closer to this line. The blue line will move up, and it'll get steeper, so it'll dip down sooner the further away from the underlying asset price. And that's really what I'm taking advantage of in short-term options. So I can pay less for the insurance on my call and put spreads. Therefore, I'm losing less money by buying that insurance than I would if I was using a longer-term call and put spread. Also, trade frequency. So this is all about probabilities. If I have a high probability of profit, somewhere between 80 and 90% probability of profit, there's still a 10 to 15% chance that I'm going to lose money. So how do I maximize my profit and loss? Trade frequency. So the more trades that you do, the more likely you will be to hit that high probability of wins, and that will allow you to maximize your profits. And that's really all there is to it. If you have any questions on that, you can email me at theportfoliobulletin@gmail.com. Of course, all of this is for entertainment purposes. Make your own decisions and consult your financial advisor before making any decisions. Otherwise, it's time for that jelly. So for those of you that don't know, the NFL draft started last night, and it's exciting to see anything to do with sports as we have been on lockdown and all sports have been canceled. So the draft is pretty much the only game in town. There's been some interesting picks. I think Green Bay takes the cake for the most controversial pick this season. The Packers, the Packers chose Jordan Love, and they traded up for him despite having Aaron Rodgers on 4 more years of a contract. Definitely a questionable decision, and there were some people, specifically Packer fans, that were pretty upset. As an Eagles fan myself, I was also a little confused. The Eagles chose Jalen Rangor, I guess, despite Justin Jefferson being on the board from LSU. He was an exceptional player. He had a great season, and then they won the national championship. Well, Jalen Rangor played for TCU, had a pretty questionable season. He showed some bursts of excitement, but really never very consistent, which is just about on par with what we've seen from Eagles draft picks in the past. So, guess we'll see how that plays out. Otherwise, here's a clip from people reacting to the Jordan Love pick.
They're crying, obviously, big moment. Happy. I want to let everybody know I'm happy for Jordan Love getting drafted. We all are. Congratulations, Bob. But Mel Kiper is not happy for Jordan Love getting drafted. Mel, how's the Green Bay Packers fans taking this, pal?
Well, good coons, pack your shit and get out of town, okay? Because everyone who's a Packers fan fucking hates you right now, pal.
Schefter just tweeted about us. Aaron Rodgers was on Pat McAfee's show earlier. No respect for AJ Hawk. Unbelievable. And said this: we haven't picked a skill player in the first round in 15 years, so that would be kind of cool, Aaron Rodgers said to us earlier. I don't remember him saying that.
Yeah. Oh, yeah.
I recall.
He did.
No,
He did. Javon Walker, last fucking receiver the Packers took.
Oh, too. Good
God damn it!
That is, of course, from the Pat McAfee show. They do a great show on it, everything having to do with the NFL, and I enjoy their show quite a bit. I thought that clip was funny. Otherwise, that's it for today. Have a great week.